Well, good Friday afternoon to everybody out there. Here's a quick video we put together today regarding something new that's come out of New York State, another law that's trying to bridge insurance gaps for folks that might not have it. It's the New York Long-Term Care Trust Act that's currently in bill format in the New York State Senate. And today I have Elise Murphy, CFP, partner and director of client services with Level Financial, who's going to walk us through the act and talk us through what people might want to know about it and look out for in the future. So Elise, I'm going to turn it right over to you. Let's talk a little bit about the New York Long-Term Care Trust Act.
Thanks, Mike. There's a lot to discuss today with this proposed legislation. First, we're going to discuss what is it? What is the long-term care trust program that New York State is considering? What are the costs? Is there a residency requirement? What's the opt-out option? And what did Washington State actually pass? Because this bill has been passed, a similar one passed by Washington State. So many states are considering modeling and copying and making their own changes to what Washington State did. First, we'll talk about what New York State is proposing. What they are proposing is a payroll tax on all employees working in the state of New York to pay for long-term care and to have and establish a long-term care fund in New York State. This fund would provide state-run benefits for long-term care to New Yorkers. Now, of course, how would this be paid for? This would be paid for by a payroll deduction for all New York State workers. And one of the big reasons why New York State is looking to pass a bill like this is because Medicaid programs are a huge expense on the New York State budget and becoming bigger and bigger every year. And the state is looking for some way to help alleviate the cost of those Medicaid programs. As I mentioned earlier, Washington State has actually passed a version of this, and 11 other states and possibly more are also considering bills like this. So what would this payroll tax look like? This payroll tax could be anywhere from 0.58% to 0.99% of your payroll. And the proposal is no cap on wages. So it does not matter how much money you earn, there would be no ceiling. The payroll tax would be applied to all of your New York State wages. And what do you get with this payroll tax? The benefit to workers would be a daily benefit up to $100 per day in various in-home care facilities for New York State workers. So you're going to have a payroll tax, and there are going to be benefits for New York State workers of up to $100 per day. Now, of course, there's a cap on these benefits, how many benefits you can actually receive from New York State in this proposed legislation. They are proposing a lifetime cap of $36,500 lifetime benefits received from this program, and that number is adjusted for inflation. So if you would be a beneficiary of these benefits one day or just paying into the system, just like everything else, hard to tell what the future might hold and how you would fall.
With that, Elise, just a quick question on that. So with the, let's say it's the 0.99%, so we'll just call it 1%, with no cap. So if someone's making $200,000 a year, they're going to pay $2,000 towards this. And if they pay $2,000 a year for 30 years, they'll have paid in $60,000, but there'll be a lifetime benefit cap of $36,500. Any information about whether they're gonna raise that benefit cap every year with inflation, anything like that, or is that still the great unknown?
It does seem like they do intend to have that $36,500 a year increase with inflation. But you made an excellent point, Mike, that somebody could pay a lot into this system over their lifetime, but maybe not get out that amount of money in benefits. I think just like a lot of other programs and taxes, you see definitely a little bit of wealth redistribution happening there.
Okay, and I'm assuming that you're going to talk a little bit about people that already have long-term care policies in the next few slides.
That's coming up soon. First, what's important to know is, you know, do you have to be a resident for New York State? What if you are working in Pennsylvania? Or what if you are commuting? You know, what does that look like? New York State is not going to have a residency requirement. So you could live in Pennsylvania, work in New York State. As long as you work in New York State, you are going to have to pay this payroll tax. And what is expected to be on the other side of that in terms of benefits is no matter where you live in the future, if you're once a New York State employee or a New York State taxpayer paying into that system and you move to a different state, New York State, according to this proposed bill, the way it's written now, New York State is also going to provide you benefits, whether maybe in the future you live in a different state.
Well, that's an interesting point then. So I just want to explore that one for a second. So theoretically, if somebody worked in New York State, let's say this passes, I'm 25 years old, I work in New York State, I work in New York State for 3 years, then I moved to Florida and I lived there the rest of my life. I'm assuming there's got to be some limit on the benefit. Otherwise, people would work just a year, pay into the thing, and then move somewhere else and not work in New York anymore and get the full benefit. There's got to be some form of limitation on this, I'm assuming.
I think you're right, Mike. That is a little unclear in the details at this point. But as we'll see coming up with Washington State, they did have stipulations to explain who exactly would get those benefits. So absolutely, that is a big question. How long do you have to have paid into the system to receive these benefits? How much do you have to have paid into the system? And I think that those are important details that the New York State taxpayers need that I think will emerge as this bill works its way through and various proposals and edits are made to the legislation. Now, one interesting thing is a question of, is there any way to opt out of this payroll tax? One opt-out that could be built into this bill would center around private long-term care policies. So, of course, right now, there are insurance companies that sell long-term care insurance policies that will cover you and cover the costs of various nursing home and other home care health aides in your home if you need them, if you're not able to do the activities of daily living, a certain number of them. And what this bill proposed is if the year in which the act passed, so let's say the act passed in 2023, if you held a long-term care insurance policy as of January 1st, 2023, you could opt out of this payroll tax. And so what we find is if this act passes in 2024, we never know how the legislative process is going to go. But if this act, for instance, passed in 2024, that would mean there's still time in 2023 for New York State workers to consider a long-term care insurance policy to maybe be able to opt out of this tax. Now, that is a very specific and highly individualized decision that needs to be part of an overall long-term financial plan that you make with your financial advisor. So very important to seek individual financial advice from your level financial advisor on this one, because there's really a lot to it, a lot of pros and cons to consider carefully in your situation. Probably one of the most affected groups from this bill would be high income earners. Because we said earlier there's going to be no cap to wages, high income earners are going to be very affected by this proposed legislation. And depending on how much someone makes, it might very well be cheaper for them to buy a long-term care insurance policy versus paying this tax over their lifetime. So anybody who's young and got a long time horizon and or makes a high income might consider this little carve out they made in the bill of having long-term care insurance. It might really make sense for them to have a policy.
Of course, that's only going to matter for the time period right before they pass. It's only going to matter for the January 1st and before. So essentially, if I think I'm reading this the right way, once this bill, or if this bill is passed, and once another year comes back around, you won't be able to opt out anyways. So it's basically a short period of time that potentially high income workers could make that decision and opt into something and save themselves some money. But after that period goes by and we pass another January 1st, you've lost that opportunity. It's a one-time decision.
Correct.
Okay. Great.
And I'm going to talk a little bit about that more with what Washington State did. So this was an actual bill passed by Washington State, not being considered it is set in stone, it is in effect. Washington passed what they called the Washington Cares Act. So that was a 0.58% payroll tax to their taxpayers. And it also had no cap on wages. So all employees must pay into the program unless they were able to take the opt-out. And again, the benefits very similar to what New York State is saying. $100 a day in lifetime benefits is what a participant in this program gets, with a lifetime cap of benefits adjusted for inflation. So that part looks very similar to what New York State is proposing. And so Washington did offer that one-time window to opt out of this tax by purchasing a long-term care policy. And what that did actually was create quite the disruption in the long-term care insurance market, because as you can imagine, everyone ran to go get their long-term care policy, and insurance companies, some even had to stop accepting applications because they were getting so many, and it created such a logjam and backlog of processing applications, and they couldn't even get them through. The demand was so high. If you look on the other side of that, of course, that's a criticism of what Washington did, because they missed out on a lot of tax revenue by having this opt-out. So that might be one thing when New York State is looking to make their final regulation, why they might want to make it either more difficult to opt out or have no opt-out at all, because they saw what happened in Washington State. It created a very large demand for these long-term care policies, and a lot of people did in fact secure those policies. And anybody paying their long-term care private insurance and not the payroll tax is a loss in tax revenue to the state.
Wow, there's a lot to unwrap here too. So one of the things I see here, the exceptions for self-employed individuals. Do we have any sense if the New York State bill has that type of exception built into it, or is this more than just what the Washington one has?
This is just specific to the Washington one. I do not have the details on what New York State was thinking for self-employed individuals.
And $100 a day, I mean, basically what they're saying is we're going to give you $100 a day for up to a year. And then, you know, that, and with considering the costs of long-term care, it's not really a big benefit. I mean,
$100 a day with that lifetime cap. So the lifetime cap up to $36,500 adjusted for inflation. And you're right, that is very easy to quickly surpass in a situation where you need long-term care because you cannot perform the activities of daily living. It is very expensive care, and it does not take very long at all to rack up very, very big bills in that area. So now Washington, what they did was they handled their program a little bit differently. In terms of, they set it up for employees who move out of the state will not be eligible to receive benefits under the program. That was the exact opposite of what New York State proposal was saying, that New York State workers, even if they move out of the state, would still be able to get some benefits. Washington State structured that differently. As you can see here, we've got some very specific rules. If you were to get benefits under the program, you have to have a total of 10 years without interruption or 5 or more consecutive years. You can see very wordy here, but a lot of stipulations about who could actually receive benefits under the Washington state law. So there are still some unknowns out there. There are still some questions. A lot, I think, we're still waiting on to come out on this proposed bill. And of course, it's just a proposal. Everything's up to be changed, edited, negotiated. Who knows? Maybe New York State will pass a version like this year, maybe next year. It's very hard to say, Mike. If you want details on that, I think you will have to interview, someone a little bit more in the know on our.
Maybe need to have a politician in the level to talk with them about what's going on there. All right, well, good, great information. Thanks for presenting this. And so I guess until next time, this is Mike Hebron with Level Financial, Elise Murphy from Level Financial, and everybody have a great day. Thanks. Bye.